Hey taxpayers, today I want to talk to you about the balance sheet. This is one of 3 documents we give here at Accounting to Scale to all of our clients, and it's a document that you should be super familiar with regardless of who your accountant is. At Accounting to Scale, we believe that accurate and timely financials are the key to you making better decisions about your business, about growing your business, about paying yourself more, about expanding. And so it's super important that you know exactly how to read this. And in today's video, we're going to break down the balance sheet. Okay, so a balance sheet has 3 main components. It's your assets, your liabilities, and your equities. What does that mean? It basically means everything you own, bank accounts, furniture, computers, inventory, accounts receivable, everything you owe, that's all your loans, your credit card, your debts, and everything you've invested or distributed. And that's the money that you've personally put into the business to make it grow, and or the money that you've taken out to reap your reward, your profits. So the formula of a balance sheet is important to know because this is what tells you whether or not your balance sheet is stated correctly. Assets must equal debt plus equity. So everything you own must equal what you owe and what you've invested. Which makes sense, right? Because the only way you can own something is whether you've taken on debt to do that or whether you've personally invested money into the company. Now let's talk more about assets and liabilities. There's something called current versus long-term, and it's pretty straightforward. A current asset is basically an asset that can be liquidated within 1 year, and a long-term asset is something that might take a little longer to liquidate. And the same thing with debts. A current debt is something you have to pay within 1 year, and a long-term liability might be something that you can pay over time. Maybe think a mortgage that takes 30 years. So within our assets and our debts, we separate current versus long-term. And we do this because we really want to understand the liquidity of our business, right? Can our current, our short-term assets, that's the bank account balance, your inventory, your accounts receivable, can these things cover our short-term liability? Think the balance due on your credit card, maybe some short-term loans that are coming due soon. If a business cannot cover those things within that short period of time, then the business is perceived to be illiquid, right? It doesn't have the liquidity that it needs to meet its obligations. Now, there's a lot of names for equity. You might hear stockholders' equity, stakeholders' equity, or just plain old equity. And it really just means the same thing. Whoever is an owner has contributed something to the business, and that is their equity. And that amount can be reduced by losses that they've taken or distributions that they've withdrawn from the business. When equity is negative, it's not a good thing. It either means that the business has had so many losses that they've had to take on debt to support those losses because the owner has not contributed enough money personally, or it could mean that the owner has taken so much out of the business that it cannot support the business function, and it is solely relying on this point on debt. It's very important to keep in mind that equity is not the value of your company. Company valuations are performed by valuation experts. The valuation of your company depends on many factors. Do you have special processes, trademarks? Maybe your profits have been very high recently for a short period of time due to a burst within a new market. Valuation experts take a look at your entire financial picture in order to arrive at what the value of your company is. And truthfully speaking, the value of anything is whatever somebody's willing to pay. So when we look at equity, we want to keep in mind that it is not the value of your company. It's essentially only what the business owner has invested or taken out of the business. Now, while the balance sheet is a valuable piece of information, it's very important to keep in mind that it is a snapshot of a single day. It does encompass everything that has happened before it because the balance sheet kind of rolls forward, but it is only as of that day. In other words, when you look at your assets, that's what you own as of that day. And that's what you owe, your debts, as of that day. So when you're analyzing your balance sheet, you do want to look at it as of that date, but you also want to compare it to other periods. Maybe you want to compare December 31st this year to December 31st last year or 2 years ago. All right, so on your screen, we're gonna put the balance sheet of a fictitious company. Go ahead and follow me along as I discuss what I'm looking at here on this balance sheet. All right, so the balance sheet you see on your screen, this company has assets, current assets of approximately $89,000. Remember that I said that current assets are assets that can be liquidated within 1 year. Cash, petty cash, inventory can be sold. There's some inventory of supplies, maybe some prepaid expenses. Total current assets, $89,000. They also have what's called fixed assets. These are assets that remain with your business over time. Think equipment, buildings, land you may have purchased. These assets get depreciated over time, which basically means that this $180,000 building will slowly get moved to the profit and loss through depreciation over time. This company also has intangible assets. Those are things like goodwill and trademarks that you may have purchased, right? They're not so much something that another business could physically see or buy, but they do provide value to your company and you invested in them financially. Next up is liabilities, and we have current liabilities here of approximately $61,000. These are the short-term things that this company needs to pay and needs to pay soon. Think accounts payable, wage payable, taxes payable, interest payable, all of these things need to be paid soon. And remember when I was talking about liquidity, if I compare the $89,000 of liquid assets that this company has to the $61,000 that it owes, this company is doing pretty well, right? It has over 1 times enough money to cover its current liabilities. Next, we have long-term liabilities, and those are going to be those mortgages or notes payable or loans in general that you will owe over time. And as you can see here, this company has long-term liabilities of approximately $420,000. And the last section is equity. Common stock, this is what the owners have invested or purchased in exchange for stock of the company. Retained earnings, this is income that the business has earned in previous years that it has retained within the business and not yet distributed, right? Treasury stock, negative $50,000, that has to do with a redemption of that stock or maybe a distribution of profits. And just like I mentioned before, assets must equal liabilities plus equity. And as you see on this balance sheet, they certainly do. Your total assets of $770,000 equal your liabilities plus equity of $770,000. So what are your thoughts on how to read a balance sheet? Has your accountant ever described to you how to read or understand your balance sheet? Are you going to run over to your accountant now and ask them for a balance sheet? Talk to us in the comments below. We love chatting with you. Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.